Awesome. So the topic for today is DeFi, specifically trades within DeFi, opportunities that can arise, some of the risks involved with it, which are often not talked about enough, and some tips that you should know in general. So we're going to be providing some frameworks, like very general ways to think about trades in DeFi. Two different types, which we'll get into, and how to evaluate each of these, the evolution of these strategies over time, and then finally we'll talk some alpha opportunities that are available right now in the market that you can take advantage of, how to manage risk in those as well, and future opportunities, and sort of the outlook for DeFi in general. Before we get started, a quick update about Into the Block. We relaunched Cardano Analytics. So they were down for a few months in time, but we're excited to have them live again. Of course, they have a very large community, so we're seeing some good traction with those analytics. And before that, in December, we also launched 20 new metrics within the platform. So some of the ETH indicators that were having some issues were also relaunched, and we released some new ratios and network analytics that can provide very valuable information for fundamental analysis. We also announced partnerships with I believe it's a wallet, like a DeFi app called Solvo. We released that and have some more coming soon in terms of partnerships, and a lot more to come from Into the Block in terms of releases. So we already did Cardano this year. The next step we're very excited about is what we're calling the DeFi Risk Radar, which offers a transparent view into all or most of the risks in DeFi, particularly from the economic side. I'll talk about this briefly, but we're excited to launch that over the next few weeks. And then we're looking to launch layer 2s in Optimism, Arbitrum, having that data for those chains in the analytics platform, making the analytics platform more usable, and also provide API access. So giving our users some of the most requested features that they have been asking for. Awesome. So without further ado, let's dive into the types of trades in DeFi. I would classify as two main types of trades that you can execute in DeFi. One is discretionary investing, which is a fancy way of saying speculating. So if you think an asset's going to go down or up, you buy, you sell. Please don't spam the chat with links. Not sure if the link is trustworthy or not. I'll continue. And the other main type of strategy which is very unique to DeFi, and what we'll talk about a bit more, are yield generating strategies. So that's essentially you hold an asset or you buy an asset to get yield on top of that asset. And that brings a very different type of strategy that's not parallel to some of the ones in traditional finance. So for discretionary investing in DeFi, it also has some differences versus traditional stock investing. One is all of the data, or at least most of it, is on chain. So you don't have to wait for like quarterly reports, quarterly earnings, where they announce how they did. You can actually check the revenues, check the traction of each of these protocols on chain. So that's a novel benefit that can be used to try to get some value and potentially forecast some trends. All of the activity is also transparent in DeFi. Of course, in centralized exchanges, it's not fully transparent, but you can track, for instance, the net buying and selling activity. We have some of those metrics productized within our DeFi insights. And one of the other features that can be both a benefit, a double-edged sword, a benefit or an issue, is that it's self-custodial. So you're responsible for your assets at all times, and that's good in case that, you know, an exchange goes down. But, you know, there's also the risks of holding your own assets, which we won't get into today. In terms of fundamentals for discretionary investing, I think especially in 2021, people over-indexed the total value locked TVL metric. So that metric has some value to it, but there's certainly a lot more metrics that you can use to gauge the value of a protocol, how it's growing, and, you know, have ideally some KPIs, some parameters that you can monitor to see how the value that protocol brings is going, and, you know, based on that, potentially forecast if it's a good investment or not. On that line, I should have stated at the beginning, nothing we say is financial advice. It never is. This webinar is no exception. So some of the metrics that you can look at from the protocol demand are the fees. So essentially how much people are paying to use it, what percentage of those fees accrues to the protocol, the trading volume, if it's, for instance, an exchange, how much volume is being traded, loans outstanding, if it's more of a lending protocol. Regardless of which type of protocol, the number of addresses could also be a valuable metric to look at, even though it can be gamed since you can create an address free of cost. From a supply standpoint, you can look at the deposits, the concentration of these deposits. This metric is sometimes hard to get, but can be very valuable because it's not the same if a protocol has 1 billion TVL, 1 billion in deposits. It's not the same if that's just, you know, 2 people supplying 1 billion versus 100,000 or more. So that's some of the metrics that we're working on. The inflows and outflows, number of depositors, and of course, from the token side of things, there's also a few metrics that you can look at to, you know, evaluate a potential investment. So one that I think the crypto industry learned the hard way is the percentage of supply in circulation. So a lot of tokens that launched with just 5% of the supply in circulation and had a lot of issuance during 2021 or 2022, they essentially got wrecked because there was too much supply getting into the market, and already with some headwinds pushing the market down, that led to a downward spiral in many of these. The distribution and allocation of these tokens as well matters. So what percentage goes to the team, the community, when it's distributed, if is that like all at once in one token, massive token unlock, or is that more progressive over time? We're also looking at incentive programs. So if you can earn more of those tokens, either through staking or just yield farming, it's important to keep those in mind. And finally, the number of holders, even though as mentioned, it could also be potentially gamed. So these are just some metrics that I typically keep in mind when looking at a protocol. And, you know, most of these, the data is public. So feel free to take a look at those. And then for yield strategies, it's important first and foremost to know what is the source of the yield. So if there's a saying, if you don't know the source of the yield, you are the yield. And it can very much apply in crypto. So it's important to know what's the underlying source behind it. So the three main, I would say, within crypto are issuance, so inflation, and it's the first type of yield in crypto in general was this. So for proof of work mining, it effectively emits inflation, and that has been mirrored by proof of stake, and also, of course, by the application layer. So a lot of applications that do liquidity mining, this is also inflationary rewards. And there's, you know, nothing wrong with that, but over the long term, it can be perhaps less sustainable. Fees are, you know, can be thought of as a potential dividend to give as well to those holding an asset. So at times, and this varies protocol by protocol, a percentage of fees can go to those staking. And so, for example, like in GMX, and this is sort of a proxy dividend, even though for regulatory purposes, pretty much no one in crypto uses the term dividend. And finally, a more recent one is MEV, so maximal extractable value. And that's essentially, like in layman's term, is indirect fees that some people pay, so known as searchers, to organize transactions in a way that they can extract profit from. We'll talk about this a bit later, actually. And in terms of the dimensions to evaluate a strategy, they are somewhat similar to traditional finance, so risk reward, except they are, the underpinning behind them are very different. So for risk in the traditional stock market, you look at the volatility, maximum drawdown in these strategies or assets that you hold. Whereas in DeFi, it introduces a whole new set of risks. So you have to look at the technical risks, if the protocol's been audited, the economic risks. Is there any slippage you can realize from entering or exiting the position, any permanent loss, any potential depegging events, and also capital risks of the tokens and the underlying models behind these tokens. Mohammed, we'll have some questions at the end if you do have, I see you raising your hand. From the reward perspective, it's a bit more similar. You can think about the reward as the potential appreciation of the position that you have or the incoming yield from it. And finally, we introduce a third vector to evaluate yield generating strategies, which is the capacity. So that's effectively how much you can deposit to still have an attractive rate. And this is often overlooked in DeFi. But it depends, if a pool is only $10,000 in deposits, and you want to deposit and it's generating 5% in returns, and you deposit 5,000, then you would be reducing the rewards in half. So actually, if you put 10,000, you would be reducing in half. So it's a matter of between the yields that you generate, the capacity that you can deposit, and the risks that these strategies involve as well. So obviously, we've seen DeFi evolve significantly. So before 2021, we already had the so-called DeFi summer, and there was getting some traction. But all in all, there were less than 100 protocols, less than $10 billion in deposits, and a lot of the strategies, like depositing liquidity in Uniswap, most people didn't fully understand impermanent loss, how it worked, and its implications. So there was, it was still very incipient, even though we still had our very first mania after the compound liquidity mining, and then even some food coins popping up, offering crazy yields, and the first few rug pulls where the developers took the liquidity deposited illegally. But even then, we had seen less than 100 million in hacks per se. So still very early days. And then in 2021, as everyone is aware of in the webinar, we see a very massive expansion in the asset prices and also in the yields available in these protocols. So there's just an abundance of risk-taking opportunity. Everyone wants more and more and more without actually fully understanding the risks. So here in 2021, as these protocols start increasing, 100x and more in terms of deposits, we see the first few hacks, and we see some economic collapses. The epitome of this is, of course, Terra Luna, with USD getting to almost 20 billion market cap before going all the way to zero. And in 2022, we learned our hard lessons from the excesses of 2021, and we experienced this period of contraction, of course. And this changes the dimensions that I mentioned before. Now it's yields are a lot harder. Reason being, a lot of those were emissions based, and the emissions themselves are worth less. Now that the tokens are worth less, the amounts of risks have been exposed, so all people are becoming more cautious now that they see, bridges getting hacked, Terra collapsing. That people get wary, and therefore they withdraw capital. And based on these two factors, there's also some decreases in the capacity, so in the amounts that you can deposit at attractive yields. And in 2023, we're seeing, at least thus far, as of February 1st, a bit of a resurgence in DeFi. It might still be too early to call it that way, but we're seeing yields improve. So here's one strategy, for instance, that's been going from like 5 to 10% just over the past few months. A lot of this has to do, of course, with the increasing prices. As an industry, we've come to understand the risks a bit better. Of course, some people better than others, but especially those making the protocols and taking decisions in the protocols have become more adept at protecting capital within the protocols. So that's important. And also there's been some improvements in capacity, as now there are some better yields, but still not as many deposits as there used to be in 2021. Now on to some of the current opportunities that we're seeing in DeFi, and some future ones. So one question that we've debated a lot at Into the Block, and I get asked about frequently is, is yield farming here to stay, or is it just a fad? And naturally, as the yields have come very low in 2022, after being in 20% plus in 2021, people start doubting that it's a fad, and it was just a bull market phenomenon, especially because of the feedback loops that I mentioned of like rewards tokens going down and the capacity going down. So that feeds on itself. But the fact is, there are some sources of yield, and some, really meaning a few, that are sustainable. For instance, transaction fees in Ethereum going back to stakers is probably the best example. And even if they're not sustainable long term, doesn't mean that they can't be over the short term. So parallel to this is what they call in traditional tech startups, the customer acquisition cost, or the CAC. And for years and years, Uber subsidized rides at a lower cost, so that they were paying the cost for the client, so that they were able to get rides for $5 or a very low amount. And this effectively came out of the team's budget. So that's a short-term incentive to attract users. And DeFi, in a way, is doing the same thing, except it's based on tokens. So instead of giving them, a discount, you're giving them tokens that you can either, get some yield on and sell for dollars, or potentially hold and be aligned with those protocols longer term. So in that way, especially if it's done during some short terms, it can be seen as a marketing expense, and also as a method, as a means to get more decentralized over time. So I think this is still likely to continue to evolve, but for the most part, yield farming is expected to continue. And so now moving on to the opportunities that we're seeing right now. There are several related to liquid staking that have been very prominent over the past few months. So liquid staking derivatives offer tokens like Stake Thief or Rocket Pool ETH, and you can deposit into these either just ETH or both, and get some share. So you earn here, the sources of yield are the yield from staking, the yield from inflation, which can come from the governance tokens of these liquid staking protocols, and also the decentralized exchanges where the trading happens. There are some risks here. So for instance, if the price of staked ETH decreases, then the value of your deposits can go down. That's a risk. That being said, with the Shanghai fork coming in March or potentially April, as withdrawals from the Beacon chain staking begin, effectively people would be able to unstake staked ETH one-to-one for regular ETH, and therefore that creates an arbitrage opportunity, which creates some pressure to stabilize the prices. And that also creates some potential tailwinds for the liquid staking tokens, as they can potentially have more amounts staked. Now that there are withdrawals, it can create confidence and less expenses in terms of the subsidies that they pay to incentivize these pools, now that they can be arbitraged. In terms of other strategies, I'm sticking here with ETH yields since to have a common example, but a lot of these strategies can also work with other assets, especially proof of stake assets. So Solana, Matic, Polkadot, and a few more. Another popular yield strategy is doing leverage staking. And what that is essentially depositing a stake derivative token. So for instance, it's an AVV3 we just recently launched. You can earn by supplying the 4.7% or so and staked ETH, borrow at 3%, and what you borrow, you swap or you stake for staked ETH, and then you earn that extra 4.75%, and you effectively pocket the difference, so about 1.6%, and every time you do it, you get a higher and higher yield. Of course, though, since you're leveraging here, you do have a greater sensibility to the price of staked ETH, such that if it decreases even to like 0.99, you can potentially be liquidated. Of course, depends how much leverage you get. So it's worth being cautious, but this can potentially bring your yields even higher, up to like 15% or so. And there's also a new types of protocol, so Gearbox, that allow leverage farming. And what this is basically a protocol that borrows under collateralized to a certain number of whitelisted strategies. So it can deposit into convex staked ETH. It could also deposit into like USDC strategies, even wrap Bitcoin strategies, and effectively it's like a curve pool where you borrow more capital and therefore you can get more yields. You do have to be mindful of like the borrowing costs, and you can also be prone to liquidation. It's more capital efficient since you do it under collateralized, but it's certainly riskier. Also, a lot of these protocols are newer, so they might have not been as tested as things as Aave or Curve. So there's some risk to be mindful there, but there's certainly a good amount of potential opportunity there. And based on these strategies, zooming out, I think we're likely to see DeFi continuing to push for to attract more users. So we're still very much in the early stages of DeFi and crypto altogether. There's a ton of protocols, a ton of blockchains and layer 2s launching, and there's a relatively small amount of users yet. So they will try to attract new users and existing users to their platforms. So this creates the type of competitive scenario where they want to get as much attention as possible, as many users. And I think this creates the grounds for more yield farming opportunities. So right now, for instance, after Optimism launched the OP token, they started doing yield farming incentives in Aave, in Curve, a few protocols, and they saw the number of transactions in Optimism grow by 5x, I believe, in 2022 in the midst of the bear market. So, it's an expense, but there's definitely seeing some of the benefits of it. Similar with the Moonbeam parachain on Polkadot, they also have a liquidity mining program going on that's been attracting users and capital. And I think that there's probably more to come. So this is just speculation, but with the recent launch of Aptos and Arbitrum being, speculated that they might launch a token, RB, and the upcoming CK EVM rollups like Starkware and CK Sync, it is likely that at least some of them will have a token and incentivize users in these platforms, especially to be able to attract, as I mentioned, more users and be competitive now that other chains and other protocols are getting a lot of activity. So that's one trend that I think is likely to start unfolding this year, especially if the market calms down, then a lot more blockchains and applications become more confident launching tokens. The second trend that I'm foreseeing is the applications providing more fee-based yields, so more sustainable in a way. So this is GMX. They're providing 8%, 8.5 almost, staking GMX. And more than half of it comes from the fees that it accrues in the platform. So it turns them to ETH. It's basically how much the trading fees that the protocol charges users, traders, a percentage of those gets redirected to those staking. And in a way that can be more sustainable over time. It also has a inflationary component to incentivize higher yields. And I think we're likely to see, and we are already seeing some of these examples and likely to continue to do. And finally, a bit more experimental, but its potential with things like DYDX chain launching, that MEV will be like a third element, like with Ethereum, that will provide yield to those holding those tokens. And this will get very interesting because it could potentially charge 0 fees and just monetize via MEV. And there's also newer applications like Manifold that has their own RPC for MEV that's aiming to give part of the MEV profits that arbitrageurs get back to the users of those applications. There's also we foresee to be greater improvements in risk management, as I mentioned before. So attack vectors are getting better understood, both on the economic and technical side. They're also getting more automated. And finally, there's increasing amount of transparency in terms of the yields and the risk behind those yields that are available in DeFi. There is a lot of educational component to be done behind that. But I think we're aiming towards a more resilient DeFi. To conclude, DeFi offers a unique infrastructure, and it has very different risks and benefits that investors should consider before depositing into DeFi. The space has evolved significantly, and as I mentioned, that has changed the amounts of rewards available, the risks that you're subject to, and the amount you can deposit in. The alpha opportunities are still around, as I just showed. People have to be mindful of the risks and also of the duration of how these yields can last, depending on if it's more fee-based or more inflationary-based. For example, since there's a natural competition for the protocols launching and blockchains, I think we're likely to continue to offer relatively high yields as the space essentially needs that to be able to attract more capital inflows. And finally, a positive note is that risk management behind all of these applications is getting more resilient. So hopefully we should also have a safer DeFi in the near to medium term. Okay, thanks everyone for tuning in. The next webinar will be about MEV. So I teased you guys about the base of it today. Our CEO, Jesus, will be talking about some of the future MEV strategies and how that's likely to continue to evolve. So make sure to sign up. Our team should be sharing the link in the chat, and I'll be sticking around for some questions now. Give me a second to see if I can share the link for the webinar. Okay, there it is. I see a few questions. Just give me a second. Okay, so if there is an interest rate that can exceed the decline rate of tokens, the further decline is likely to accelerate due to increased distribution. I think this is a comment from Soon Young. I'm trying to understand this question. I believe you mean that if the amount of supply entering the market is larger than the current amount, there's likely to be some downward pressure. I see a better formulated question. Thoughts on low cap DeFi projects that were once adopted by thousands of inactive users, but now only have less than 100,000 TVL. What do you think is or are needed for these projects to get market attention in the upcoming bull phase? That's a better question. Frankly, you'd have to look at it in a case-by-case basis. There's a lot of protocols that now have under 100,000 TVL, and we're back in like the billions. And that has to do, in some cases, with their over-reliance on yields. So if you look at something like the token rewards that are fully inflationary based, like Curve, you know, that platform is still very high in terms of TVL, but it went from like 20 billion to 2 billion, if I'm not incorrect. Someone can double check me. But that has to do if they have a certain over reliance in rewards. In some cases, a lot of protocols might be able to recover and attract more users. But that's why I mentioned, like, try to understand how much of the demand depends on just the yield that's being provided versus the protocol being more natural fit and more attractive. And you know, it depends on a case-by-case basis, but I do think some protocols will be able to recover significantly, and new ones emerge, of course, as I was mentioning, GMX being a good example there. Greg is asking, can you share more info on your upcoming risk radar tool? So it's essentially, we're launching it with 2 or 3 lending protocols, and we're allowing a very deep dive into the economic risks that involve depositing into those platforms. So you can look at things like high risk loans, liquidations, a lot of the existential factors that can bring lending protocols to zero. We're also extending it to AMMs and more DeFi protocols later in the quarter. But the idea is to have a lot of transparency on the risks that people incur when depositing into DeFi protocols. And so far, we're seeing some traction from the protocols themselves looking to access this data. And the idea is to have it fully free for the end users. So that's you know, an advantage that we hope to bring to the DeFi community altogether. Leonard is asking, what strategies are you using the most? Unfortunately, I don't think I'm allowed to disclose some of the strategies that neither me personally or us into the block that we execute. Some of them, like we talked about, but I won't state exactly where I'm depositing my capital. But you can look at some of these protocols like Aura, Aave, being mindful of the risks that I mentioned, of course. So Palash is asking, explain a bit about MEV trading. So that's a topic for the next webinar, so I don't want to give it all away. But effectively, if in a block of transactions, you can extract value from where you are in that block. So typically you want to be either the first or the last person in a block. You can do arbitrage opportunities, for instance. That is the predominant type of MEV, but there still are many different types of MEV. So the most common is a sandwich attack, where you see, someone wants to buy $1,000 worth of ETH in Uniswap at a price of, let's say it's currently at 1,600. And so what MEV allows is someone to pay to be upfront of that transaction. So you move the price up, you move that price from like 1,600 to, let's say, 1,610. And then that second person ends up buying at 1,610, and the person paying for the MEV can then also sell at 1,610 and make the difference. So it's a bit of an arbitrage, and they pay a fee to Ethereum stakers in order to prioritize their transaction ahead of yours. So it's a bit of an indirect cost to the user, and in a way, it's a profit for those looking, or the MEV searchers looking for these strategies. Okay, so final question. I got two actually. So someone's saying that exchange inflows record might not be actual transactions. So why do people think that when exchange deposit increases, prices fall? It's a relationship that we've studied, and this has to do more with centralized exchanges, and we have data on this. What we've studied is essentially it used to be more like large deposits going to exchanges and potentially selling happened later, since there's more liquidity, at least right now, in centralized exchanges. But as people started looking at this metric, some people started just manipulating it, or you also depositing it to exchanges for other reasons. So it's not necessarily a causal relationship, so it's not causation behind that. But it's a good data feed to look at, and time and again, when there's some panic scenarios, we see very large inflows into exchanges when people are looking to sell. And of course, when there's things like panic on FTX and exchanges crashing, we also see a large amount of outflows. But there it has less to do with buying or selling. Okay, now, final question. What innovations in DeFi do you want to see in the coming future that probably still not exist? I think that has to do more with derivatives in DeFi. So we've seen demand for perpetual swaps. Again, DMX, DYDX being good examples. But options still haven't taken off, and they manage in the traditional world an order of magnitude more volume than spot trading. So there's some product launches that I'm keeping an eye on there, like the Ribbon Finance team is launching Aevo, an options marketplace that I would like to see hopefully get more traction for derivatives in DeFi. This will also bring, the reason why I brought this slide is that it should also bring more fee-based yields, since derivatives have relatively high fees and market fit within crypto. So I think that could be the next leg up for crypto to continue growing. And other than that, we're also seeing some innovations like Parcels was an interesting protocol that I saw launched in Solana, where they have real estate derivatives, where you can essentially invest in the price of the average real estate. I think it's the median within a city. So effectively, you can get some exposure to some cities, even hedge if you're paying for land in a city and you don't want the price to go down. I think that's an interesting primitive. And overall, I'm optimistic that out of this bear market, we'll see more innovation come through. Okay, guys. Thanks everyone for tuning in. I appreciate, and hope you guys had enjoyed the presentation. We'll see you in the next one. Have a good day.